Good evening and welcome to this week's edition of Wealth Quest. You're watching CNBC Africa. We're first in business worldwide. I'm Samantha. Our topic of the week, focusing in on funds and their performance during the second quarter of 2013. Now, even though it's not advisable to look at fund returns over the short term, they do provide a glimpse into manager thinking and where sentiment has driven returns. So tonight we'll bring some context to some of the returns you might have seen from the marketplace in quarter two. The JSE All Share index gaining 2.3% for the first half of the year. Industrials gaining 8.7%. Financials gaining only a paltry 0.1%. Resources, of course, the big standout, down 18.2% for the first half of the year. Joining us from our studios in Cape Town to give some context to the second quarter of this year, David O'Leary, Director of Morningstar South Africa, and of course, one of our guest hosts, Cobie Legrange, strategist at Clucas Gray Investment Managers. Welcome to you all. David, let's just provide some context to what we saw in quarter two. Just give us a theme breakdown right now in terms of what are the key themes that drove quarter two returns.
We're seeing a continuation of what we were seeing towards the end of last year and the first quarter of this year, which is a cooling of the South African economy. In particular, continued labor unrest has been a key part of that. Pressure on precious metals and other materials that are mined, and then ultimately a depreciating South African rand, which has actually been a real boon to South Africans investing offshore.
And of course, very specific stocks in South Africa have managed to benefit from rand weakness. Let's just run through some of the top categories, Cobie.
Yeah, let's have a look quickly at, just for the quarter, what some of the top categories were. And if you have a look at your screen right now, you'll see some of those top categories. Now, what we've done over here is we've actually taken the charts and we've actually gone and ranked it on a quarterly basis. And then obviously you could see the year-to-date and one-year numbers there as well. And if you have a look at you'll see that, interesting enough, some of the best performing category is actually what they call regional interest bearing or short term, which you can see is up on the 3-month basis by 9.2%. Global equity general up by 8.9%, and then global multi-asset high equity up by 8.8%. And I mean, there's two factors that kind of drove into that space for me. Rand weakness and the fact that the S&P obviously was up as well. And there you can see it on your screen. You can see they're both of those kind of globally how well they've done. And obviously on the one-year numbers, those have done obviously phenomenally well. Those are fantastic type returns. At the bottom end of the categories, if you have a look at your screen right now, you'll see South African equity resources down 14%, and I suppose with the index down minus 18%, minus 14%, I suppose it has to be seen in light of that. Look at the year-to-date numbers and the one-year numbers. I mean, those are all negative for resources, and that continues to kind of be the theme that David spoke about around kind of minerals and resources in South Africa at the moment. Financials, on the other hand, minus 3.7%, and then interest-bearing variable term is down by 2.1% for the quarter, and obviously that one-year numbers continue to to kind of look okay. David, I suppose, one of the things that's starting to play into our investment space is the fact that yields are kicking up on the US as far as US treasuries are concerned, and that obviously is influencing the whole fixed income world, so to speak.
Yeah, that's definitely true. I mean, there's there's a real hot debate right now in the developed world on whether bonds are in a bubble and whether they're offering the safety that investors have typically associated with bonds, given the run that they've had and just how compressed yields were. So unfortunately, it presents a situation where investors are really unsure where to put their money as a result.
David, let's jump into looking at the various categories. Let's take a look at domestic equity in quarter two. In terms of best 361 Met equity fund, they're coming out on top for the 3-month period. But run us through who stood out for you.
What stood out to me out of this list, you mentioned 361 Met, SASFin Met 1 is the next on that list, and I think the common theme among these funds that have topped the charts for this quarter were an underweight to materials for the reasons we mentioned just before, and just a lot more diversification. So they didn't have exposure to the sector that had performed the worst by far, and that is really, if you were a manager who had a large weight to materials, and the miners in particular, you were in trouble.
And of course, this is where the value investors have been playing, Cobie. So no doubt that the value investors, unfortunately, yet again, come at the bottom of the category list this time around there.
Yeah, I mean, have a look quickly at your screen and you'll see some of the worst performing domestic equity managers for the quarter, and you can see their 1 year numbers as well. And obviously that's the value theme just not coming through at this moment. I mean, obviously this is going to change at some point. At some point, something is going to shift. The resource cycle is going to start again, and you'll probably see many of these managers start doing well as well.
With a hope and a prayer, all those value investors are saying right now.
No, absolutely. I mean, there is investing value. I suppose that's the one. The media attention on investing value is absolutely huge, but there's other things that have done worse. Look at Momentum Value and Personal Trust SA Equity there, which is a fund which is run by Sandy LaRue and Craig Clue. Both of those obviously not having done that well. So maybe the disparateness in the kind of return numbers that we're seeing for equities at the moment shouldn't make somebody just jump ship. You should potentially philosophically be asking yourself, do you buy into what the fund manager is trying to do? And quite frankly, should you be staying with the funds, with your fund choices? Is that not true, David? I mean, you can't look at these disparate short-term numbers and say, I should be out of this fund and maybe into something else.
No, that's exactly right. And unfortunately, with value investors, you want the manager to show the courage of their conviction. Somebody like John Bicard at Investec Value has been through a really rough period. Seems to be sticking to his guns, which is what you want to see, because they need to be able to ride out those periods where those stocks are going to continue to come under pressure and eventually wait for the rebound. The trouble is then deciphering, when are you just wrong about the call? And I don't know that that's the case here, but it's always the challenge an investor faces with an aggressive value manager. There's different shades of value investing. John Bicard's not afraid to make really big bets and concentrate on few sectors and few stocks. So if you're going to buy a manager with that approach, you're going to be sometimes left in those situations where you just don't know whether to keep holding them or when it's time to pull the plug.
There we go. Certainly a balancing act between discipline and then choosing perhaps a new tact or new strategy. Let's jump into the fixed income space, because if you're looking at the returns here, really paltry, I suppose, if you look at the best performer, ABSA multi-managed bond, only 0.1% return in the 3-month period, and I suppose mirroring what's taken place, David, in the bond market.
There's not a whole lot here to distinguish these funds. The range of returns is pretty narrow. And they're just, this is a considerable pullback from the returns we've been seeing on fixed income over the past, 5 years or so. So again, you're left with this situation where a lot of these bond funds where you'd expect to be a store of value aren't playing that role in the investor portfolio right now. So I'm sure that's creating quite a bit of concern among investors.
Yeah, as a matter of fact, on your screen at the moment, you'll see domestic equity property. And you'll see the property funds. Look at the returns over 3 months. I mean, those are fairly thin returns as far as these funds are concerned. There you see Anton de Goede's Coronation Property Equity Fund. Look at the 1 year returns though. Most of those returns obviously come from the back end of last year. Last month hasn't been kind to property, and that's just as yields continue to tick up. Let me show you the worst domestic property categories. And you can see there's not a massive disparity between these and obviously, the best performing categories.
Yep. David, for you, are you having any conversations specifically with fund managers of these property funds to find out where their heads are at when it comes to the outlook for the property sector? Any specific themes that are standing out here for you?
Actually, property is an area that I haven't been able to cover any managers in that space yet. So unfortunately, I don't. Cobie actually may have a little more insight into that space.
There we go, Cobie.
Well, firstly, I think the property space is generally a very rough space to invest money with at the moment. I think, you've had these massive run-ups in these values. The yields themselves are starting to mimic and look a bit like bond yields. And as people become more and more fearful that bond yields are going to shift up, then quite frankly, property yields should be giving you something more in order to entice investors to continue to invest in them. If you take the domestic, kind of property market, I don't think you're seeing many of those kind of fundamentals at play. It certainly is playing itself out in the global space. Yeah. There certainly is a lot better opportunities in property globally than there are locally.
So there we go, David. Before we end off, as always, we like to look at which fund managers you have been able to touch base with this time around since we last spoke. So any new funds that you've been able to look at from the Morningstar perspective?
Yeah, I'm in the process of writing a bunch of reports. My most recent visits included Clyde Rousseau at Investec and the folks over at Allen Gray. It's just an interesting comparison. These are folks that run a couple of the biggest balanced funds in the country. And it's just interesting to note where their similarities and differences lie, particularly when it comes to things like the mining sector. You've got a lot of split opinion on it, and you'll see folks like John Bicard who are just loading up thinking there's tons of value. You've got an Allen Gray that seems to be a lot more in the middle, somewhere saying that certain names in that space are getting pretty attractive, and at the right price we'll own it. And then you've got guys like Clyde Rousseau who say, it's just the inconsistency in their earnings and all the problems surrounding them just make it an area that I prefer not to invest a little less in that area, and tends to be a little more hesitant to play in that space.
And you mentioned the currency at the beginning of the show. So how's Rand weakness playing into strategy right now?
It's a good question. On balanced funds, even ones that are Reg 28 compliant and have to keep 75% invested here at home, they can invest up to 25% abroad. And what you are seeing is a lot of managers, partly because of the fundamentals of South African economy, and them not expecting as attractive returns at home, but also partly because their outlook for the Rand, expecting it to continue to depreciate, have upped their foreign currency exposures. And it's for those who have, like a Clyde Rousseau at Investec, that's certainly paid off for them.
So Cobie, of course we're in Q3 now, so it's time to look forward as to what we're expecting for the rest of the year. Do you think more of the same themes playing out that have, of course, driven returns in Q2?
That very much depends. Firstly on the equity front, I think it very much depends on what's going to happen politically in South Africa, and also what's going to happen to, I suppose, resource prices globally. Yeah. Those two kind of fundamentally shift where resources are going to go in South Africa, and I think that's going to be a major driving force as far as the South African market is concerned. And then as far as your fixed income market globally is concerned, that's going to kind of be the precursor of what is going to happen in South Africa as far as bond yields are concerned. And by default, anything that is yield driven and anything that where there's a search generally for income. And it'll be interesting to see how the rest of the year pans out. South African market is not cheap relative to some of its global peers. And it's kind of coming off the back end of a kind of a heyday for emerging markets and being an emerging market. So it'll be interesting to see how South Africa kind of plays out in that space next 6 months.